For those who think the market is getting close to another sell-off, Macquarie's Martin Lakos says, think again. He joins me in the studio. Hi, mate.
Bit good. How are you?
Very good. And is that true, or have I exaggerated?
No, well, there's not quite exaggeration. You know, I think we've got to define what we're talking about in terms of valuations. So people talk about the broad market, and yes, if it's on a P of 15, it's starting to sort of head towards...
That's where it is now, you're saying?
Yeah, 15. Above average sort of valuations.
Yeah.
But the question by a lot of investors is, how much of the market's rally has been on what we call PE expansion, not followed by earnings revisions? And we think that there's some in the market are mistaking or being mistaken that there's not enough earnings revisions upwards. And we think there are. We think earnings growth is continuing. But this has been, as you and I have been talking for quite a while, very much a stock picker's market, very much a focus on those global stocks and now a little bit towards the Australian domestic cyclicals. And in that group, particularly those stocks that look like they're very expensive, high PEs, Seek.com, REA, Ramsay Healthcare, really good examples of those. The question you've got to ask is, what is the earnings profile? And looking at these, all those stocks, we're finding there is continued upward revisions, and we're looking very much at stock specifics here. So upward revisions, or the revisions ratio for each individual stock, not just the broad market. And this data is actually quite positively surprising. We're seeing some good upward revisions across that group. So we're pretty comfortable that earnings will get delivered.
Okay, you singled out Seek, REA and Ramsay. Are these companies that actually fit the bill?
They do fit the bill, absolutely.
So don't worry about the PE, because their earnings will justify their PE.
Correct, absolutely. I mean, if you look at stocks like JB Hi-Fi, who've had this phenomenal run now, we've seen a decline in the revisions ratio, but it's still at 1.7. Now, the revision ratio is really looking at the number of upward revisions versus the number of downward revisions.
Okay.
So if you get a number of 1 or more, you're seeing more upward revisions by analysts across the market. So this is not just Macquarie's analysts, this is across the broader market, although Macquarie's analysts are obviously
part of it. So that 1.7 was specifically for JB Hi-Fi?
Yes, exactly.
And so that means that you're saying it'll probably do okay.
Revisions ratio is still positive. We're very happy with that. You know, Westpac's seen a decline in the revisions ratio. It's still at 5. So the banks are really seeing significant.
It's a long way from 1.
It's a long way from 1, Pete. So we have to be quite specific about the stocks, but in terms of looking at sustainable earnings growth over the next couple of years, that's where we think investors should be focusing on, and not the big broad brush number.
Yeah, but Marty, when all you really smart people at Macquarie go and have your play lunch or your lunch, you must talk about play lunch. When you must think, well, the old saying, sell in May and go away. What are you guys saying to that old maxim, which sometimes works?
And it's seasonal. And, you know, the last couple of years it's been right. The market's had a good run. It might pull back. It almost becomes self-fulfilling, doesn't it? To some extent. But we would be saying, if there is any pullback, and I can't predict that it will or won't be, we would see this as a buying opportunity. Because
the next earnings period, which is in August, is it?
Yeah, well, the June 30 actually gets reported in early August.
So in a sense, in fact, I actually mentioned this in the Switzer Super Report. When you look at what's actually happened, often there can be a sell-off in May, but by September, because the old saying was, sell in May and come back on St Ledger's Day. And because that's the UK version of the American sell in May and go away.
Right.
And the idea was that a lot of the brokers would actually go to Henley for the rowing, Ascot for the racing,
fund managers,
Lords
the professional investors.
Yeah, and they didn't have the internet or
just not
smartphone.
active.
That's right.
But
often they actually did come back and they bought really heavily. But now you might still sell in May, but they'll buy in June or July because it's a bloody good opportunity.
What's the consensus forecast for the ASX 200 index by the end of this year? It's 5,900.
Yeah.
So we're talking another 10% almost from here.
That's
plus
the
dividends.
It wasn't that high at the beginning of the year, was it? It's getting better and better.
It's getting better.
And you're saying earnings is the driver for
earnings on the whole will be the driver.
Love that, because you know I'm at 6,000. All right, so outlook for steel. Now this is interesting. You guys have done a bit of special research on steel, which should be good for BHP and Rio.
Well, it's quite poignant because today we saw a big sell-off, particularly in the likes of Fortescue and BHP and Rio, on the back of a futures market on iron ore getting sold off really heavily over the last couple of days, down about 7%.
Was there a reason behind that?
Well, I don't know this specifically. It may have to do, and I really don't know, Pete, but I suspect it's to do with the expiry of futures and options at the end of this month. That's possible.
We're getting close.
But what is interesting is that our analysts in China have done a survey, they do it quite regularly, of 40 steel mills, 40 steel traders, and about 40 iron ore traders.
Very biblical. 40 days and nights. Hang on. Yep.
But the outcome of all this is that we are starting to see a pickup in sales, a pickup in demand by end users for steel. We know that
the factories that use steel.
Absolutely. We know that we've seen a significant runoff in stockpiles over the last 6 months. In other words, the inventory buying hasn't been there. It's running at about 22 days at some steel mills, and it's the profitable steel mills that are getting more active. So we think that we'll see a reversal of this demand profile, a positive reversal for steel and obviously iron ore going forward over the next couple of months.
So those who've been negative on China may well get a bit of a surprise.
Possibly so, yeah. And, there's no question that we're starting to see some activity by the authorities out of China. They are going to target many stimuluses across China. So, for example, they've relieved or adjusted the reserve ratio, the amount of capital banks have to hold, particularly to the agricultural sector. So they're clearly trying to avoid a property bubble, but will target the stimulus at certain sectors within their economy.
Good sum, good sum. Now, what about takeovers? We're hearing a lot of takeover talk. Is that usually synonymous with an improving market, Martin?
It usually is. Is this a Dorothy Dix question?
Well, it is. We didn't discuss it before it came on, but as I was listening to you, there are a real lot of takeovers starting to develop. And all I always feel is that it's when people say, well, we've got to get in now because this market could take off and we miss out on a great buying opportunity.
Well, coming out of the US, there is definitely a lot of signs of pick-up in M&A activity, mergers and acquisitions activity. The same here in Australia. And when you think about it, if there are good assets for sale, interest rates are low, balance sheets are in great shape, we haven't seen much industry consolidation take place over the last number of years. So, it would certainly suggest that there are the makings of a pickup in that activity. And what we see, if the takeovers are for assets that are listed, that money tends to get recycled back into the marketplace. So clearly there are assets for sale out there that are non-listed, but certainly we should be keeping an eye on what might be picking up. Now, how do you, as an investor, participate? Well, we haven't got a crystal ball about trying to pick what the targets might be, but the companies that will benefit from M&A, companies like Computershare, for example, because every time there's a corporate action, every time there's new monies being held by a share registry group, Computershare is a big beneficiary.
Good point, good point. Now, what about banks? A lot of people, who watch this show know we were talking banks up, when the price went off the boil a bit. I think CommBank was around 71 or something like that. It's now around the 79. What are you guys saying about the banks?
Well, we've been heading more towards a neutral stance, largely because our big asset allocation has been more towards growth and cyclicals as away from the high-yield securities. But at the end of the day, as I've been talking for a long time, our clients, particularly those with super funds and SMSF and pension mode, need income. And clearly the banks have been providing a great income stream. And so that's still very much the case for a lot of clients out there. I guess to some extent you've got to be viewing the banks in two areas. One, the last reporting season saw Commonwealth Bank come up with a better than expected result. The NAB and ANZ trading updates were better than expected. And that revisions ratio started to pick up. In other words, there are upgrades taking place in the marketplace. And two, if you're getting a bit more positive about the Aussie economy, particularly for the second half of this year, aren't the banks a bit of a proxy for the rest of the economy?
I would have thought so.
And if that's the case, you've got to be reasonably comfortable the banks are in reasonably good shape.
I agree totally, Martin. Thanks for joining us on the program.
Thanks, Pete.
Always great to see you.